a legitimate corporate finance phenomenon on Wall Street now. There's no question that $150 billion worth of equity has been raised through SPACs since the beginning of January 2020. And it's going gangbusters, as you pointed out. January and February were probably the biggest months for SPAC equity raising in 15 months. And the question is typical of what happens on Wall Street. Are people going too far? Is it out of hand? Are people getting out of control? Is it too much? Are the incentives too much swayed in the favor of the SPAC sponsors, the hedge funds, the smart guys who have figured out how to put these things together, get equity cheap, and try to merge with a private company? That's on the one hand. And on the other hand, are we now sort of scraping the bottom of the barrel of companies that are going to merge with a SPAC? And so, again, my point would be that it's a legitimate corporate finance activity on Wall Street. It's absolutely started to supplant the traditional IPO, which is very interesting, and it's a great way for companies to go public and people to raise money. But is there going to be a fallout? And I think there is a fallout that has already started among various of these SPACs that have gone too far. And you saw your friend Chamath taking money out of Virgin Galactic, which I think 250 million or so out, which started to make investors quite nervous. Right. So I think we're starting to hit a peak and coming down the other side now.
That's Jason's bestie. Be careful how you talk about Chamath.
No, he's fine. No problem with Chamath.
Jason, you made the distinction before. You've made the distinction before. There are good SPACs, there are bad SPACs, and now we got commentary this week from the SEC. Beware of the ones that are being marketed, or at least don't buy them if you're just drawn to them by the famous faces who are now seemingly all behind them. There you go. Celebrity involvement in the SPAC does not mean, this is the disclaimer, that the investment in a particular SPAC or SPACs generally is appropriate for all investors. And we're also going to throw on our wall the SPAC-a-palooza. Literally, so many of the most popular names on Wall Street now, as we know, have SPACs. There's Wilbur Ross now up in the upper left-hand corner. Even Wilbur's got one. Is it gone too far?
Yeah. No, and in fact, we have more to go, and we are nowhere near the downside of this. That's completely ridiculous. It's actually going quite the opposite. There are hundreds of companies with billions of dollars in revenue that are private right now, and it would be very healthy for those to be publicly traded companies, to be under the scrutiny of being a public company, and to have that discipline, and to allow market participants to not just buy the top 10 stocks and own Disney and Apple and all the big names and be overbought into those, and allow those mid-tier companies to create a currency to acquire other companies and to compete. This is amazing for America and for all investors, from the employees in the company and those stakeholders all the way up to Chamath, taking these companies public, and to the retail investors who get to buy them.
Well, it's most amazing. It's most amazing for the sponsors, though, right? That's who it's most amazing for.
I think they get a good deal. The sponsors get a good deal, but they have to set up, I think they spend about, $10 million setting these things up. So there is some risk involved. And if these companies are not high quality merchandise and they're not high quality revenue, those people who bought those early shares in the SPAC can just redeem, from what I understand, and take their cash back. So there are some self-correcting mechanisms here. And in terms of vibrant capitalism, we now have 3 ways to go public: direct listings, the traditional route, and SPACs. That's good. Overall, capitalism benefits by competition. Now, founders and investors and boards can pick one of these 3 choices, or the 4th choice. If you don't want to deal with public markets, stay private. But we're going back to the 80s when technology companies went public in year 5, 6, or 7, as opposed to years 10, 11, and 12, Airbnb and Uber did. And that's good, but you just have to be careful. If you're buying in the public, you're now a venture capitalist in some cases. You're buying private companies that are losing money. Be careful.
You end on exactly the point that, Bill, I wanted to go back to you on, because that's what you say the real risk is. Absolutely. Retail investors getting burned through all this about stuff they don't know about. They may be enamored by the big names that are in it. It seems like a sexy place to be right now until the market changes.
Yeah, it's a classic bull market phenomenon, and excitement and enthusiasm, and it feels like it's just going to go on forever. The trees are going to grow to the sky until, next thing you know, sentiment changes and the whole thing falls off a cliff, just like mortgage securities did, bonds did. just like internet IPOs 1.0 did. People who've not lived through a bear market don't appreciate what's going on here. And I agree with everything Jason's saying, by the way. I think it's a great phenomenon. It's great that there's now a third alternative for companies to consider when going public. But this is just getting way out of hand. It's just too many dollars chasing too few opportunities. When, the Churchill 4 SPAC goes up, almost infinitely when they talk about the merger with Lucid Car Company, and then on the reality, the SPAC goes down 50%. Who gets hurt there? Not Michael Klein, the former Citibank investment banker. Who gets hurt are the investors who bought at the top of that little peak and now are down 50%.